is Bryce Knorr, Senior Editor of Farm Futures Magazine. Welcome to The Buzz for Thursday, July 19th, 2012. Market analyst Arlan Suderman joins me from Wichita to discuss a historic day for futures prices. Corn and soybeans rallied to new all-time highs overnight, with corn trading above $8 a bushel and beans for the first time using a 17 handle. While rains overnight helped northern Indiana and Illinois, as well as southern Wisconsin where I live, most areas of the Midwest likely won't benefit much from the system, with warm weather expected to persist for at least a week. Before talking about specifics, let's go over the tone of the market. Today, for the first time, the wires seem to be buzzing with the type of stories that appear to indicate signs of panic by both end users and sellers who have realized they're either short bought or they may not have enough grain to cover commitments. While that's taken the market to record prices, it could also signal that a top could be closer, not further away. What's your sense, Arlan? Does this have the makings for a blow-off top now? And where is it likely to appear first, in corn, soybeans, or both?
Well, that's an excellent question. I think both. Yes, I do think it does have the makings for a blow-off top. I started getting that question yesterday from readers, and I'm pretty concerned about it. Do I think the market's done its job yet? No, I don't. But the dynamics here suggest that this market is ready to sell off. The market doesn't have to do what we think it has to do. It can behave illogically at times and do what it does, so to speak, when money is all chasing in the same direction. Now, the final phase of a bull market is typically when we see the speculative funds taking profits and getting out while the end users are in a panic mode, and then suddenly the end users realize they're the only ones buying, and they stop and the whole thing collapses and collapses in a hurry. A lot of times that happens 2-3 days before a big rain event moves through the Midwest, and no one's anticipating that big rain event. Well, the next event is still a few days off. This one disappointed, although it did do a significant amount to boost the corn yields in downtown Chicago, and that does tend to affect sentiment of Chicago traders. But this market is acting awfully top heavy. A lot of people starting to talk, well, we're at record prices. They want to be the first to sound the caution alarm and say we're near the top, you better start selling. I just sense that sentiment. I don't think we've brought supply and demand into balance yet. I don't think the trade has a grasp of the significance of losses, but a premature sell-off wouldn't surprise me at all.
Of course, there's good reason why corn passed $8 today. Crop ratings continue to deteriorate. Yield potential dropped sharply again this week, with my average now at just 128.8 bushels per acre nationwide. That's the lowest of analysts surveyed by Reuters, and it suggests two things. First, demand rationing will be necessary, as we've seen this week. Ethanol production is the lowest since the government began releasing weekly data 2 years ago, and if the pattern continues, overall corn usage for the biofuel could be 50 million bushels below USDA's current 2011 crop target. Exports are also slowing, adding to the potential for an increase in old crop carryout. The second impact of worsening new crop production is on prices, of course. The selling range for my model now stands at around $8 to $9.30 for new crop. That suggests the rally, at least fundamentally, could have a ways to go. Arlan, what's the upside and the downside? And there's been a lot of talk about buying puts or selling futures to guard against a drop in prices that could decrease crop insurance payouts. Is it time to be playing defense?
I think it's always time to be playing defense in a market like this, where big volatile swings are likely at any moment. But let's put a little perspective to it. You said our models show a yield of 128.8 bushels per acre, and we've seen deterioration since that point, and the outlook for the rest of the month would suggest that we'll see more deterioration as well. But let's use a 130 bushel yield. Now let's also use abandonment percentage of 85.5%, not the actually harvested percentage of 85.5%, which is very similar to where we were in the drought of 88 and in 83. And we're hearing reports of silage choppers going across the Midwest right now with heavy abandonment as farmers walk their fields. Even in northwestern parts of the Midwest, finding that the ears aren't there they thought they were from the road. But if you use 130 bushel yield and abandonment like we saw in similar droughts in the past, that gives us a 10.7 billion bushel crop. That's 4 billion bushels smaller than USDA was projecting last month. We have rationed a lot of demand, as you indicated before. We have not rationed demand enough to account for a 4 billion bushel loss. But as I said, the markets don't always have to do what you think they have to do, and there's various ways of doing that rationing. So I do think it is time to start taking some defensive stances, trying to protect. Of course, the crop insurance, revenue crop insurance with harvest option protects well above $11, but that will probably be well off the highs by the time we get to harvest. So it does make some sense to try to do some things to protect the current highs, because the crop insurance guarantee will probably pay something less than what the high is this year.
While demand for corn has noticeably slowed, end users are still scrambling for soybeans because there's little supply available out of South America due to the problems they had this year. This helped drive soybean meal over $500 a ton Wednesday for the first time, spurring August futures in soybeans to a new nearby high as well, which they erased with today's surge past 17. Soybean ratings also deteriorated in the latest week, with my projected model currently at 37.8 bushels per acre. With demand still strong, that creates impossibly tight, if not negative, ending stocks projections for the 2012 crop. Adding to the uncertainty is a potential lack of double crop acres due to dry conditions. As a result, my model projects a selling range from 1620 to 1810 for new crop. Arlan, I'll pose the same question I did for corn. Where's this market going, and what should farmers be doing about it?
Yeah, when USDA released its first balance sheet in May, I felt like they were underestimating demand. And then when we got the June and July reports, I felt like, particularly in July, that it was assuming we would do some demand rationing because the crop wasn't there, and we've shrunk the size of the crop since that point. And this market really hasn't started doing the rationing. Export sales are still overall seasonally strong, although this week's sales numbers were down closer to seasonal levels. Prior to this, we've been above seasonal levels for this time of year. We saw 4 million bushels of U.S. new crop soybeans sold to the United Kingdom this morning. That's more than their whole annual amount, really, for the last 5 years, over the 5-year period. They normally buy from Brazil, not from us. That shows that U.S. soybeans are where the market's at right now. We're also being complicated by another matter. You mentioned soy meal prices at record highs. With corn ethanol production slowing down, the supply of dry distillers grains and solubles is dropping rapidly, and farm producers, livestock producers who are depending on DDGs as a source of protein, are having to turn back to soy meal. And so the demand for soy meal is pushing crush margins back. Domestic crush is seasonally strong. We really haven't rationed demand yet with $17 soybeans. So how high may it go? How high is justified? Well, I think $18 is very much in the ballpark that you gave in your range, and very well maybe $20 or more. It depends where we actually start rationing. China has shown that it still wants the soybeans, and it has about 25 to 30% more buying power because of lower freight rates and currency exchange rates than it did in 2008. And the livestock industry still wants the protein for its diets. Protein is a higher return component of its input costs. And so it's a more inelastic demand for soybeans, but I still believe there's profits to be made if you have an idea what your crop will produce and what your revenue coverage covers, to be incrementally selling in at these profitable prices.
Wheat has been content to be a follower recently, but there were signs end users are finally getting the message. Wheat is going to cost them more money this year. USDA reported better than expected export sales today in the latest week after a sluggish start to the selling season, and there were a flurry of deals in the international market after buyers canceled a series of tenders due to the rally. Jordan, which had canceled 3 previous tenders, finally threw in the towel today and bought at higher prices. While these and other deals out of the Middle East appear likely to be sourced out of the Black Sea, exports from that region could eventually be limited due to weather problems. It's still raining in Europe, raising more quality concerns there, too. Production also should be lower in Australia and Argentina as well. Arlan, should farmers with 2012 crop inventory be selling into this rally? And how about 2013 crop sales? The price discovery period for winter wheat crop insurance doesn't begin until mid-August. Is it too early to begin selling next year's crop?
Well, you're exactly right that the crop insurance guarantee calculation period hasn't started yet. We're a month away from that. But let's also remember these are very profitable prices for producing wheat, even if nitrogen costs go up significantly because of the higher grain prices. So we need to keep that in mind. I was asked yesterday about what this does to world stocks. At this point, we'll have to wait and see what happens with El Nino and the dryness in particularly Western Australia to their production and where Russia and the former Soviet Union's production comes in. At this point, I don't think globally we're going to run out of wheat, but we will likely draw supply snug, but still have enough. The question then comes to 2013. If we return to a more favorable weather pattern with these higher prices, we could see broad expansion of wheat in consuming countries and the non-exporting countries. That could really decrease the demand as we go into 2013 and start rebuilding supplies. On the other hand, if we continue to have this pattern of adverse weather and problems with production around the world, next year could be the explosive time. Bottom line is, I think it makes sense at these price levels to be starting selling your first 10 to 15, maybe 20% of the crop, incrementally taking advantage of these prices, even though it's early, because of the threat that if the corn market does prematurely crash, it will likely pull wheat prices down with it.
Well, thanks, Arlan. Keep up with daily developments at farmfutures.com and www.datelinedrought.com. And we'll be back next week with another edition of The Buzz.